Welcome back. I want to open today's episode with a question, and I want you to sit with it for a second before I give you the answer. Here it is. What is the single biggest reason most people never start investing? If you guessed not enough money, you're in very good company. In fact, survey after survey, and we'll get to those numbers in just a moment, points to the same thing. People believe you need a significant amount of money already saved before investing even becomes an option. They think it's for people who already have their finances figured out, people with extra, people who are not them. And that belief, more than any market crash, more than any economic recession, more than inflation or interest rates or anything happening in the global economy right now, that belief is the single most expensive thing most people are carrying around in their heads. A 2023 survey by Bankrate found that 26% of Americans cited not having enough money as their primary reason for not investing, making it the #1 stated barrier, ahead of debt, lack of knowledge, and distrust of financial institutions. Here's the truth, the real truth, backed by both research and the mechanics of how modern investing actually works in 2026. You can begin building an investment portfolio today with literally $0 to start. Not 100, not 50, 0. And over the next however many minutes we have together, I'm going to show you exactly how that works, step by step, with science behind every move. Let's get into it. Chapter 1. Why the "I have nothing to invest" mindset is costing you. Before we get tactical, I want to spend a few minutes on something that most personal finance content skips entirely: the psychology of why people don't invest, even when they have the means to start small. We live in a culture that has, for generations, treated investing as something that happens after you've cleared a certain financial threshold. You pay off your debts first, you save up a big emergency fund, then maybe you look at investing. And while there's some reasonable logic in that order, the problem is that for most people, after all of that never actually comes. Life is expensive. Emergencies happen. The threshold never gets cleared. Research published in the Journal of Behavioral Decision Making found that individuals who delay financial action due to perceived inadequate resources experience what researchers call decision paralysis, a state in which the gap between one's current situation and an idealized starting point becomes so psychologically large that no action is taken at all. In financial terms, this paralysis has measurable compounding costs over time. Decision paralysis is real, it is documented, and it is financially devastating because while you are waiting to have enough to start, inflation is quietly eroding your purchasing power. The market is generating returns you're not participating in, and perhaps most painfully, time, which is the single most powerful ingredient in long-term wealth building, is slipping away. Let's put that in concrete terms. If you invest just $50 a month starting at age 25 at an average annual return of 8%, you'll have approximately $174,000 by age 65. If you wait until 35 to start the exact same $50 per month habit, you end up with around $75,000. The amount you invested is almost identical. The difference, nearly $100,000, came entirely from the decade you waited. Nobel Prize-winning economist William Sharpe's foundational work on portfolio theory, alongside decades of empirical market data compiled by Ibbotson Associates, consistently shows that time in the market, not timing the market, and not the size of your initial investment, is the dominant driver of long-term portfolio growth for retail investors. Time is the variable you control most directly right now, and every single day you are not invested is a day you are giving that variable away for free. So let's talk about how to stop doing that, starting with nothing. Chapter 2. The modern investing landscape in 2026. What has actually changed? It's worth taking a moment to acknowledge something important. The barrier to entry for investing has never, in the history of financial markets, been lower than it is right now in 2026. And I don't mean that as a motivational platitude. I mean that as a literal fact about the infrastructure of the investment industry. 20 years ago, opening a brokerage account required a minimum deposit of anywhere from $500 to $25 $500. Buying a single share of a major company like Amazon or Google, which trades in the hundreds or thousands of dollars, was simply out of reach for anyone who didn't have that kind of capital sitting idle. Mutual funds charged 1% to 2% annual expense ratios as a standard fee, quietly draining returns year after year. And the entire system was structured, whether intentionally or not, to favor people who already had money. That world is largely gone. Today, every major brokerage, Fidelity, Charles Schwab, Vanguard, and a growing list of newer platforms offers accounts with no minimum deposit requirement. You open the account, you link your bank, and you are in. No minimum, no waiting until you have a magic number saved. According to data from the Financial Industry Regulatory Authority, FINRA, the number of retail brokerage accounts in the United States grew by over 40% between 2019 and 2023, a surge driven almost entirely by the elimination of account minimums and trading commissions at major brokerages, which began in earnest in late 2019. That stat matters because it tells you something about human behavior. When you remove artificial barriers, people invest. The barriers were never really about the money, they were about the structure, and the structure has fundamentally changed.
Here's the feature that has arguably done more to democratize investing than anything else in the last decade: fractional shares. A fractional share is exactly what it sounds like: a fraction of a single share of stock or an ETF. This means that if Apple stock is trading at $200 per share, you don't need $200 to own Apple. You can own $5 worth of Apple, which represents about 2.5% of a share. Same goes for an S&P 500 index ETF, an international fund, or a bond fund. You can build a properly diversified portfolio with as little as $1 to $5 per position. A 2024 report from Fidelity Investments found that fractional share investing had become the entry point for over 40% of their new account holders aged 18 to 34, with the median first investment being just $16. This suggests that when the minimum viable investment is reduced to a psychologically accessible level, first-time investors act quickly and decisively. Think about what that means for the person sitting at home tonight thinking they don't have enough to start. You can open a Fidelity or Schwab account tonight with $0, fund it with $20 from your next paycheck, and buy fractional shares of a diversified index fund before the week is out. That is not an aspiration. That is a literal sequence of steps you can take right now. The other major development worth understanding is the rise of robo-advisors, automated investment platforms that build and manage a diversified portfolio on your behalf, based on your risk tolerance and time horizon, for a fraction of the cost of a human financial advisor. Platforms like Betterment and Wealthfront have no account minimums and charge annual fees of around 0.25% compared to the 1% or more a traditional financial advisor typically charges. For a beginning investor with a small portfolio, this means your money is being professionally managed, automatically rebalanced, and tax optimized for roughly $2.50 per year per $1,000 invested. A 2023 study published in the Journal of Financial Planning found that portfolios managed by robo-advisors with automatic rebalancing outperformed self-directed portfolios of similar asset allocations by an average of 1.5 percentage points annually, primarily because automated systems removed the emotional decision-making that causes most individual investors to buy high and sell low. What this means practically, even if you know nothing about investing, even if the words asset allocation and rebalancing mean absolutely nothing to you right now, you can start a robo-advisor account with $0 today, set up a $25 monthly automatic contribution, and have a more sophisticated investment strategy than the majority of Americans. The technology does the work. Chapter 3. Step by step. How to actually start with $0. Okay, let's get into the practical steps. I'm going to walk you through this as if you were starting from absolute zero. No brokerage account, no investment knowledge, and no money set aside yet, because that's where most people actually are, and that's who I'm talking to. Step 1. Fix the leak before you fill the bucket.
Here's something no investing platform will ever tell you because it's not their business model. Before you invest a single dollar, you need to make sure you're not losing money faster than compound interest can grow it. And the most common, most silent way that happens is through high interest debt, specifically credit card debt. The average credit card in the US currently charges an interest rate somewhere north of 20% annually. The S&P 500 has historically returned an average of about 10% per year before inflation. That math is not complicated. Paying off a 20% debt is a guaranteed 20% return, better than virtually any investment on earth. Research from the Federal Reserve Bank of Boston found that the average American household carrying credit card debt pays over $1,000 per year in interest charges alone. For those households, eliminating that debt before investing generates an immediate, risk-free return that no market investment can reliably match. So step one is this: get a clear picture of your debt. If you have high-interest credit card debt, attack it with urgency. If your only debt is low-interest debt, a mortgage at 4%, student loans at 5%, that's a different calculation, and in those cases, it often makes sense to invest alongside paying it down. But credit card debt at 20% or more, that's your first investment. Pay it down. Step 2, build a minimal emergency buffer. I can hear some of you thinking, wait, I thought we were talking about starting with zero. We are, but here's the thing. Investing without even a minimal financial cushion is a setup for failure. Not because the market will collapse, but because life will throw something at you. A car repair, a medical bill, an unexpected expense. And if you have no buffer, you'll be forced to sell your investments at the worst possible time to cover it. You don't need 3 to 6 months of expenses saved before you start investing. That's the traditional advice, and while it's sound, it leads a lot of people to delay investing for years. Instead, aim for a starter emergency fund of $500 to $1,000, enough to handle a minor unexpected expense without derailing your investment plan. Once that's in place, you can start investing while continuing to build your full emergency fund in parallel. A 2022 report from the J.P. Morgan Chase Institute found that households with even a small liquid savings buffer of $400 to $1,000 were dramatically less likely to carry month-to-month credit card balances, miss bill payments, or experience financial disruption from minor income shocks, confirming that a small buffer has outsized protective effects on overall financial stability. Step 3. Open a zero minimum brokerage account tonight. This step is simpler than most people think, and it should take you less than 15 minutes. Go to Fidelity, Charles Schwab, or if you want the robo-advisor experience, Betterment or Wealthfront. Click Open an account, and for most people starting out, a Roth IRA is the ideal vehicle if you have any earned income yet. Contributions go in after tax, grow completely tax-free, and can be withdrawn tax-free in retirement. If you don't have earned income yet, or if you've already maxed your IRA for the year, a regular taxable brokerage account works perfectly well. The point is to get the account open. An empty brokerage account is worth infinitely more than no brokerage account because it removes the friction between you and your first investment. Behavioral economists refer to implementation intentions, the specific, concrete plans of when, where, and how to perform an action, as one of the strongest predictors of follow-through. A 2001 meta-analysis by Peter Gollwitzer, published in The American Psychologist, found that forming a specific implementation plan, such as I will open a brokerage account tonight after dinner, more than doubles the probability of actually completing the action compared to a general intention alone. So here is your implementation intention tonight. After you finish watching this video, open your laptop or your phone, go to fidelity.com or schwab.com, and start the account opening process. You don't need to fund it tonight. Just open it. That one action puts you ahead of a significant portion of the adult population. Step 4. Automate a small, consistent contribution. This is arguably the most important step, and it's where the research is most unambiguous. The single most effective habit for long-term wealth building is not picking the right stocks, not timing the market, not finding the best performing fund of last year. It is automating a consistent contribution, however small, on a recurring schedule. Set up an automatic transfer from your bank account to your investment account. It could be a $25 per week. It could be a $50 per paycheck. It could be $10 $10 per week if that's what you can honestly commit to without it causing hardship. The amount matters far less than the consistency. Set it and forget it. The Save More Tomorrow program, developed by behavioral economists Shlomo Bonartzi and Richard Thaler and studied across thousands of participants, found that automatically escalating savings contributions, starting small and increasing incrementally, resulted in average savings rates more than 3 times higher than those achieved through voluntary, intention-based saving. Automation removes willpower from the equation entirely, which is precisely why it works. Once your automatic contribution is set, your investing is essentially on autopilot. Every paycheck, a portion goes to your investment account before you even see it. Over months and years, this quiet, boring, automated behavior is what separates people who build wealth from people who wonder where their money went.
Step 5. Buy a simple, diversified index fund and leave it alone. Now we get to the actual investing. And I want to be very deliberate here because this is where people overcomplicate things in ways that actively harm their returns. They try to pick individual stocks. They chase last year's top performers. They move in and out of the market based on headlines and gut feelings. And the data on how well that works is not encouraging. The S&P Dow Jones SPIVA scorecard, which tracks the performance of actively managed funds against their benchmarks, consistently finds that over any 15-year period, roughly 90% of actively managed U.S. equity funds underperform a simple S&P 500 index fund. Not occasionally, consistently, over every rolling 15-year window for which we have data. So here is the research-backed recommendation for a beginning investor in 2026. Buy a low-cost, total market index fund or an S&P 500 index fund and hold it. Do not touch it when the market drops. Do not sell it when financial headlines sound scary. Do not move it into cash when you get nervous. Just buy it on your regular schedule and leave it alone. If you want slightly more diversification, a simple 3-fund portfolio works beautifully. A U.S. total stock market index fund, an international stock index fund, and a bond index fund. That's it. 3 funds. Held forever. Rebalanced once a year. This strategy, in its simplicity, has outperformed the vast majority of professional investors over virtually every meaningful time horizon. Vanguard's landmark research on investor behavior, published in their ongoing series Quantifying the Investor Gap, found that the average investor in actively managed funds underperformed the funds themselves by approximately 1.5 percentage points per year, solely due to poor timing of when they bought and sold. Investors in passive index funds showed a significantly smaller behavioral gap, in part because index funds attract investors who understand the buy and hold philosophy. Chapter 4. Finding the money when you think there is none. I want to address something directly because I know some of you are watching this and thinking, this all sounds great, but I genuinely do not have 25 spare dollars at the end of the month. My budget is already stretched to the limit, and I hear that. It's real, and I'm not going to pretend otherwise. But I also want to challenge that belief, gently but firmly, with some data. A 2023 consumer spending analysis by the Bureau of Economic Analysis found that the average American household spends approximately $273 per month on what economists classify as discretionary, non-essential consumption. Things like subscription services, dining out, convenience purchases, and impulse buys. This is not to shame anyone's spending, but to illustrate that for most households, the money to invest exists. It's just not currently being directed there. I'm not telling you to cancel every subscription and eat nothing but rice and beans. What I am saying is that a single, targeted audit of one spending category, just one, often reveals $25 to $50 per month that can be redirected without meaningfully changing your quality of life.
A few specific strategies that research supports. The latte myth is overblown, but the subscription audit is real. The average American now pays for 4.5 streaming and subscription services, according to a 2024 J.D. Power survey. Canceling one or two unused subscriptions can free up $15 to $30 per month immediately. The roundup investing apps like Acorns automatically round up your everyday purchases to the nearest dollar and invest the difference. You don't feel the money leaving, but over a year, those micro investments add up to meaningful sums, often $300 to $600 annually without any conscious effort. The 24-hour rule on discretionary purchases. Wait 24 hours before buying anything non-essential over $20. Research consistently shows this simple pause reduces impulse spending by 30 to 50%, freeing up real money for savings and investment. Sell something. Most households have $200 to $500 worth of unused items sitting in closets, garages, and storage units. Selling on Facebook Marketplace or eBay converts idle clutter into a genuine starting investment fund, often enough to fund the first several months of contributions. The point is this: for most people reading this, the money to start investing is not the obstacle. The decision is the obstacle. And once the decision is made, once the automatic contribution is set up, the money has a way of appearing because you start to see your spending differently when every dollar has somewhere to go.
Chapter 5. The Wealth Mindset. What separates people who build wealth from those who don't? I want to close this section with something that goes a little deeper than fund selection and account minimums, because the mechanics of investing are honestly the easy part. The hard part, and the part that the research keeps coming back to, is the psychological and behavioral dimension of wealth building. One of the most consistent findings in behavioral finance is that the difference between people who successfully build wealth and those who don't is not primarily income level, investment knowledge, or access to good advice. It is the identity they hold about themselves in relation to money. Research by financial psychologist Dr. Brad Klontz, published in the Journal of Financial Therapy, identified 4 core money scripts. Unconscious beliefs about money inherited from family and culture. Individuals who held the belief investing is for people with money, a scarcity-based money script, were significantly more likely to avoid investing entirely, regardless of their income level. Conversely, those who identified as investors, even before they had invested a single dollar, began the behaviors of investors, tracking spending, setting savings targets, and making consistent contributions. Identity precedes behavior. If you tell yourself the story that you are not the kind of person who invests, that investing is for other people, people with more education or more income or more financial sophistication, your behavior will follow that story. But if you make the decision today to call yourself an investor, even if your portfolio has $17 in it, your behavior will begin to follow that identity too. This isn't motivational fluff. It's documented in the academic literature on financial behavior, and it is arguably the most important thing you can take from this entire video. Here's another way to think about it. Most people understand compound interest, the idea that your returns generate returns and the effect snowballs over time. What fewer people think about is that financial behavior compounds too. The person who opens a brokerage account tonight and invests $20 is more likely to invest $30 next month. The person who tracks their spending for 30 days is more likely to find $50 they didn't know they had. The person who reads one chapter of a personal finance book this week is more likely to read 2 next week. Small actions build habits, habits build systems, and systems build wealth. A longitudinal study by Luceri and Mitchell, published in the Annual Review of Financial Economics, found that financially literate individuals, defined not just by knowledge but by consistent engagement with financial planning activities, accumulated, on average, more than twice the wealth of similarly earning peers with lower financial engagement by the time they reached retirement age. The gap was not primarily explained by income differences, but by differences in the compounding of good financial habits over time. The bottom line is this:
The best investment you can make right now is not in a particular stock or fund. It's in your own financial habits and the identity you're building as someone who manages money intentionally. Everything else follows from that. Let me bring this home with a clear, specific action plan. Not someday, tonight. This week, because we've established that time is your most valuable asset, and every day you delay has a calculable cost. Tonight, open a zero minimum brokerage account. Fidelity, Schwab, or Betterment if you want the hands-off robo-advisor experience. The account opening takes about 10 to 15 minutes. You do not need to fund it yet, just open it and complete the setup. This week, do a 1-hour subscription and spending audit. Go through your last 30 days of bank and credit card transactions. Identify one thing you're paying for that you don't genuinely use or value, and cancel it. Redirect that money to your new investment account. This paycheck, set up an automatic investment contribution. Whatever you can honestly afford, $10, $25, $50, set it to transfer automatically on payday. Before you have a chance to spend it on anything else, it goes to work. First investment, buy a fractional share of a total market index fund or an S&P 500 ETF. Fidelity's FZROX has a 0 expense ratio and no minimum. Schwab's SCHB and Vanguard's VTI are both excellent. Pick one and buy it. You can always add more funds later. Long game. Do not look at your portfolio every day. Seriously, research shows that investors who check their portfolios more frequently make worse decisions. They're more reactive, more likely to panic sell during downturns, and more likely to chase performance. Set your contribution on autopilot, review quarterly, and let compound interest do its quiet, powerful work. That's the whole plan. 5 steps. None of them require wealth, none of them require expertise. All of them require only a decision, the decision that today is the day you stop being a spectator of other people's financial lives and start being the architect of your own. The market will go up, it will go down, there will be scary headlines and economic uncertainty, and days when your portfolio's balance makes your stomach drop. None of that is new. Markets have always done this. What has also always been true is that patient, consistent investors who stayed in the market through every downturn have been rewarded over any meaningful long-term horizon for which we have data. You don't need a lot of money to start. You need a decision and a direction. You made the decision when you clicked play. Here's your direction. Now go open that account. Thanks for watching. Share this with someone who keeps saying they'll start investing someday. Like, subscribe, and leave a comment and tell me, what's your first investment going to be? I read every single one. See you in the next one.